If you have money sitting in savings account right now, there's a very good chance you are losing money every single month and your bank statement will never show it. Here is exactly what's happening and what to do about it. Last year, UK savers lost 17.6 billion in real purchasing power, not to bad investments, not to scams, not to any decision they actively made, just the inflation quietly doing its job while their savings accounts quietly failed to keep up. And here is what makes this uncomfortable. These were not careless people. They were doing what most of us are told to do. Keep cash, stay safe, do not take risks. The problem is that advice has a hidden cost that nobody puts on your statement, because there are two ways to lose money. The obvious way, your balance drops, and the invisible way, your balance stays the same or even rises, but everything it needs to buy gets more expensive faster than your interest can cover. That second one is happening to millions of UK savers right now, silently, legally, completely within the rules. In the next 8 minutes, I'm going to show you exactly how much this is costing real people and why it keeps happening and the specific steps that actually fix it. Starting today, the numbers tell the story directly. UK inflation last year was running at 3.4%. The average easy access savings account was paying under 2%. The gap, 1.4 percentage points, is where your money went. And the scale matters. There is currently 1.88 trillion sitting in UK household cash deposits. And that's the emergency funds, life savings, and long-term money of millions of people, much of it quietly going backwards every single month. So, how exactly does that happen? To understand it, you need to be clear on what inflation actually is and what it does to your money. Inflation is the rate at which prices rise over time, and that's it, nothing complicated. You have probably felt it. Your weekly shop costs more than it did 2 years ago, filling your car costs more, a coffee costs more, and that's inflation doing what it always does, steadily pushing up the prices of everything you buy. The Bank of England targets 2% per year, and last year it was running at 3.4%, which sounds like a small difference until you put it next to what your savings account was actually paying you. And let me show you exactly what that looks like in numbers. Let me put the exact numbers on it. Say you have 10,000 in an easy access savings account paying 2%. End of year, your balance reads 10,200, and that looks like progress. It feels safe, but with inflation at 3.4%, the same basket of goods now costs 10,340, and your balance grew by 200. Your purchasing power needed to grow by 340, and you are 140 short. That 140 did not vanish in a crash. No bad decision, no market panic, just a quiet arithmetic of inflation doing its job while your savings accounts did not do it. Now, multiply that across 1.88 trillion in UK cash savings and you get roughly 17.6 billion gone quietly and legally. To be clear, holding cash is not wrong. 3 to 6 months of essential expenses in an accessible savings account is sensible. That's the foundation of any solid financial plan. No argument there. The problem is when cash becomes the default for everything, including money with a 5-year or 10-year time horizon. And that's where the real cost adds up. Here is a number that should change how you think about this. Historically, UK equities have beaten inflation in around 95% of all rolling 10-year periods since the late 1980s. Cash managed that roughly half the time. So that's not an argument against cash. Cash has a clear role, but it is a precise statement about what cash is and is not, designed to do over the long term. Because most people hold far more cash than any short-term need justifies. and that gap has a real and measurable cost. So there are 4 steps specific in order. The first one, keep your emergency fund in cash 3 to 6 months of essential spending. That logic holds. But be honest about what actually counts as an emergency fund versus money you simply have not decided what to do with yet. Those are 2 very different things. Second, if you are staying in cash, at least get the best rate available. Right now, the top easy access accounts are paying roughly 4 to 5%. The average is still under 2%. Switching takes 20 minutes and can mean 250 to 300 more per annum on every 10,000. That's not investing, that's simply not leaving money on the table. Third, separate your money by time horizon. Cash for the next 12 months, completely different conversation for money you will not need for 5 years or more. Fourth, for long-term money, consider whether cash is the right tool at all. Fidelity Analysis estimates that if just 25% of UK household cash savings had been invested in 2025 instead, the real value could have grown by roughly 44 billion after inflation. That's the cost of doing nothing, not a crash risk, the cost of inaction. So, should you invest? Here is the honest answer. If you have a solid emergency fund, no high interest debt, and money you genuinely will not need for 5 years or more, then keeping all of that cash is not caution. It's a choice with a measurable cost attached to it. Investing doesn't mean picking individual stocks. It does not require expertise or large capital. It means putting long-term money into something with the potential to grow faster than inflation. A diversified fund, an index tracker, a stocks and shares ISA. The principle is simple. Give your money a chance to do more than just sit there. The risks are real. Markets go down as well as up. In the short term, they can move sharply. And that's why the 5-year minimum horizon matters, and it gives your money time to recover from short-term falls and still come out ahead. Every major institution uses the same 5-year benchmark for the same reason. It's not arbitrary. It's built from decades of market data. Now, once you decide that some of your money belongs in investments rather than cash, there's one more question. What type of investment? At the simplest level, there are 3 asset classes that matter for most people. Cash, low risk, low return, protects against short-term volatility, but loses ground to inflation over the long term. Right for money you need within 12 months. Bonds, loans to governments or companies that pay fixed interest, more stable than equities, right for medium-term money or as a buffer within a portfolio. And equities, shares in companies, high risk in the short term, strongest long-term growth track record. The 95% inflation beating stat we covered earlier, that's equities. Most people do not need to choose between these. A diversified fund holds all 3 proportions matched to your time horizon and risk tolerance. But understanding what each one does and why is the foundation of every sensible financial decision from here. So, the 17.6 billion is not a story about bad decisions. It's a story about default behavior. Money left on autopilot while inflation worked quietly against it. If your cash is there for a clear reason, emergency fund, near-term spending, it belongs there. But if it's there because you have not decided yet, that indecision has a price tag. The question is not whether cash feels safe. It is whether cash is actually protecting your wealth. If this was useful, subscribe. There's a lot more to come. See you next time.